Hello, this is Michael Ball, Managing Director of Weatherstone Capital Management, with a market update as of July 27th, 2020. So the main things that we want to cover today is an update on where we stand as far as coronavirus, how it's impacting the economy, how the economy is doing in terms of rebounding from the pretty much full lockdown that we had seen back in March and April. We'll look at the rebound that we're seeing in stocks, how that is shaping up, looking at past historical comparisons that may be relevant. And then we'll also look a little bit at the bond market and then gold and how they're faring in the current environment. First, I want to visit briefly about what's going on with coronavirus. Obviously, we've been seeing record numbers of new coronavirus cases here in the United States, and that's causing additional lockdowns and rollbacks of some of the lockdowns going on out there. A couple of different ways to look at it. This chart here shows the total number of cases on a linear scale. So as they're going up, and we didn't really slow down too fast, and then it's been picking up a bit of speed here over the past few weeks. This chart takes the exact same data but shows it in a logarithmic scale. So instead of just the numbers themselves going up, it's showing it on more of a percentage adjusted basis. So essentially the distance between moving from, say, 100,000 to 200,000 cases is going to be equal on the chart from moving, say, from 1 million to 2 million cases. And so when we're looking at this, it's basically on the percentage growth of the number of cases. The curve has flattened out more, and although still picking up, not nearly at the percentage rate that it was early on in the pandemic, which is a very good thing, because had we kept up at that rate, then we would have been at some of those early concerns of hospitals overflowing, needing the emergency healthcare space, and some of those things that were serious concerns from some of the policymakers early on in. An encouraging chart that I would like to note is that as we look at the number of daily deaths, they have been dropping significantly from where they had been earlier in the pandemic. And although they have upticked here in the past few weeks as the number of new cases have picked up, it's been at a much lower magnitude than what it was back a few months ago. So whether it's the combined resources of the healthcare system being able to better address it, whether it's potentially that the virus is mutating to become a little bit less lethal, regardless, this is positive news that although we're seeing more cases, we're still seeing quite a bit less deaths on a per capita basis than what we were seeing before. Example of just how sudden and sharp the economic deceleration has been over the past few months. This chart looks at the number of employed individuals here in the country, and essentially it shows that we wiped out virtually all of the job growth since the last recession in just 2 months. But fortunately, it's beginning to rebound pretty quickly. Hopefully this trend will be able to continue for us. Charts that are helpful in terms of looking at the magnitude of the decline that we've seen. The chart on the left looks at the Purchasing Managers Index for both manufacturing and services. As you can see, the decline was both very sharp, and it was deeper than what we saw during the Great Recession during 2008. The chart on the right basically is taking a look at global gross domestic product growth. And so the estimated level here during the first quarter drops down to almost as deep as we saw it pick up during the depths of the Great Recession. So obviously the magnitude both here and on a global basis is very significant. We saw the large drop in the stock market, but we've seen a bigger and faster rebound than what we had seen initially from the decline in 2008. So hopefully we'll be able to see the economy pick up and maintain enough momentum that it can justify how far stock prices have moved. This chart is similar to the global recession model that we look at, but it looks at the state conditions index inside of the United States. The shaded areas show where we have had recessions in the past. And as it's shown now, we've jumped up to a high level at 100 and back into recessionary levels compared to what we've seen in prior deep recessions. What we're looking for here is for that number to start moving down and moving down fairly rapidly to signify not only that we're starting to improve, but we have a more sustainable and potentially long-lived recovery for the economy. A chart that we find very interesting and helpful to measure the rebound that's going on in the U.S. economy comes from the Dallas Federal Reserve, where they are using metrics that track mobility of people with their cell phones and how much time they're spending out and about relative to what they were before the pandemic. And so we can see on the chart the dashed line was showing basically the average of what those customer mobility levels were in January and February, the significant decline as the lockdowns and the stay-at-home orders were in effect to try to minimize the virus. And then as things have started to reopen, we've seen a pretty good rebound. But that rebound has flattened out and started to drop and then rebound just a little bit more as the second wave of coronavirus cases has hit. And some states have rolled back the lockdowns and the reopenings, and people have just started to become more cautious once again. If we stay flat for very long, then it's also likely that we're going to see the economic recovery also begin to stall out. So this gives us a pretty good, almost real-time look at how people are moving around, how they're getting out spending, etc. And so it's very useful in terms of keeping a pulse on the current activity in the economy. I mentioned in prior commentary that we're looking at past economic episodes to look at similarities that may give us a potential roadmap and things to watch for. There's a number of similarities in this current decline to the decline that we saw around and after the terrorist attacks of 9/11. The chart shown here takes the orange line, which is how the S&P 500 acted right before, during, and after the 9/11 terrorist attacks, and then the decline in the blue line is showing the coronavirus sell-off and the subsequent rebound. One of the things that's very interesting in this is that in the case of 9/11, there was a fairly weak economic backdrop and markets rebounded on hopes that the economy would be able to pick up and do well, but then subsequently rolled over and went to lower lows when the economy really didn't rebound and in fact stayed weak and got somewhat worse. So with this rebound, there's hopes that with all the government stimulus, we'll have the worst behind us, we're back to growth, we won't have a longer-lived recession. But if we do see the economy stall out, even though the rebound has been fairly long, it could look like and be similar to what we have seen back, once we go back nearly 20 years ago to that particular episode. I want to spend a few minutes just talking about some of the things going on in the bond market. We saw bonds initially hold up well in the decline, but then as we started moving further through March, they had experienced a significant decline as well. One of the big reasons for that decline came from the fact that with legislation that was implemented after the financial crisis of 2008, bond dealers needed to reduce their inventories. And so as shown on the chart on the left-hand side, the amount of inventories that these bond dealers would carry shrunk significantly. And as a result, bonds just tended to pass through them. They really didn't tend to buy them for their inventory if it was a really one-sided market. That caused spreads to rise, which is shown on the right-hand side of the chart, so that buying or selling those bonds got more expensive. And so as we went through the decline and that liquidity had dried up, it became significant enough that that's part of the reason that the Federal Reserve came in with some programs to help to restore liquidity in the market, because it just wasn't functioning like it normally has in the past. So this chart shows an example of what happened to different areas of the bond market. The blue line is showing the yield on high yield corporate bonds. The black line is showing the yield on BAA corporate bonds, so higher quality than the high yield bonds. And then the red line is basically your 90-day treasury bills. And so where there was no risk to treasury paper, as we went through the sell-off in March, we saw yields on treasury bills come down virtually to zero as the Federal Reserve cut interest rates. Initially, there was a jump higher as there were concerns over how bad the recession might be, and so you saw the yield on both the blue and the black areas pop higher. But once the Federal Reserve announced they were implementing bond buying programs to help to stabilize markets and that they could buy a significant amount of bonds, that brought yields down on higher yielding bonds somewhat, but on higher quality bonds, they kind of came back to where they were before, and in some cases are moving even lower. There's still above average spread on high yield corporate bonds, and this may give us a pretty good opportunity going forward depending on how the economy behaves. The yield right now is higher on these bonds because there's a concern over how high the default rate may be in these securities. The chart is showing the current yield on high yield corporate bonds and also then the default rate in the blue line underneath. Historically, as we have gone through a recession, we will see the default rate tick up as well as the yield on the high yield corporate bonds. As we start to come out of that, particularly if we come out of the recession earlier than expected, then we see yields start to come down as prices move up because defaults are not going to be as high as expected. This can give us, and has given us oftentimes in the past, a historically strong trade in high yield corporate bonds where we can make some nice above average returns over the next 12 to 24 months. As an example of where interest rates may go and why high yield corporate bonds may be quite attractive once the economy begins to settle down, this chart is showing the yield on 10-year government bonds as well as the inflation adjusted yield. And so over the past few months, as the Federal Reserve has cut interest rates in an effort to help both businesses and consumers, we've seen interest rates, particularly once they're adjusted for inflation, drop back to essentially less than zero. So as investors look at where can they get a positive return on their bond investment dollars, particularly after adjusting for inflation, it's going to tend to start pushing them out of treasuries and into areas where, although they are taking on some higher risk, there is the potential for higher rates of return. And so this is why, as we look at some of these areas that are more cyclical in nature and can have higher risk, but at certain points in the economic cycle tend to give very strong returns, we're setting up for what has historically been a good time for high yield corporate bonds once we see the economy start to pick up and show a sustained recovery. In our last commentary, we'd mentioned that one of the most attractive areas that we found in the bond market was bonds that are backed by housing. And this chart shows the average home price for the US. And as we look, the shaded areas once again are our past recessions. And really the only significant decline that we have had in home prices was during the last recession, and that came from some factors that were before that helped to push the trend up quite a bit faster than what it's typically been in the past. And so as we're seeing so far in this decline, home prices are staying quite stable. And so for bond prices that are backed by the value of homes, they stand as something that's more attractive in many cases than bonds that are backed by businesses, because some areas in the economy and some businesses are seeing more steep declines in essentially the value of their businesses than what we were seeing in housing. So there's a better potential for recovery rate if there's problems that happen with a bond. So housing-backed bonds still remain quite attractive in this environment. The final area that I want to talk about is gold. And gold is something that we have owned in some of our equity portfolios since last year, and we have added to it so far in 2020. It's up to about 12.5 to 15% in some of our investment strategies like asset enhancement, diversified growth, and balanced growth. Gold is an asset class that can do well during periods of economic stress or when there are fears of inflation. And so with the things that have been going on because of coronavirus, it's given a bit more of a tailwind to that asset class. There's concerns as the US government and other governments around the world have been pumping in a lot of stimulus money into the economy to try to support things, that it could potentially become inflationary, or that the coronavirus could impact longer lasting negative impacts on the economy. And so people become increasingly concerned about what's going to store value well long term. And gold tends to fit into that pretty well. So we're seeing gold doing pretty well. We have seen it over just the last few days come to and hit record highs that are surpassing the ones that we have in this chart from back in 2011. We may continue to add somewhat to our positions in gold. We're willing to be very flexible in terms of the areas where we can go to make a profit as we go through different economic cycles. And this is an example of one that there are certainly some places in the economic cycle gold does not really make much sense to have it in the investment portfolio. But there are other times when it can and does work quite well. And so this is just a quick highlight of one area that we have had in the portfolio that is really a non-traditional asset class that we have had and we do still continue to find pretty attractive at this point. In summary, the economy has been improving, but it's slowed down quite a bit as we've seen the second wave of coronavirus cases pick up. But even with the numbers upticking, we haven't seen a significant regression in the amount of economic activity. So that's a potentially positive sign. However, we do have the risk that we run into a scenario that's similar to what we had seen after 9/11, where if the economic rebound stalls out or starts to roll over, that you could see a stock market, even though it's picked up quite a bit in gains over the last few months, give back all of those gains and more over the concerns that we have a longer term economic decline in front of us. The Federal Reserve has been doing an awful lot to try to stimulate the economy, and they've been keeping interest rates extremely low. And they're talking that should still continue to be the case for at least the next couple of years. This should be quite positive to our bond portfolios, our income-focused portfolios over the next couple of years. But as some of those bonds mature and things, it is going to start to become a bit more of a challenge to find attractive bond yields once we start to get further on down the road. Finally, gold may be a pretty solid performer for us as we're in this period of very high deficit spending and concerns over what the future course of the economy will be and the potential inflationary impact from the amount of money that's being printed and pushed into the economy. With that, thank you very much for taking the time to listen to our update. Please give us a call or shoot us an email with any questions that you may have.